Everyone, welcome and thanks for joining us today. We're going to be discussing market and economic themes for the fourth quarter, which obviously we're currently in. We'll also be looking back on the third quarter, recapping the market and various economic and sector themes that we're seeing and things that could continue to drive the market into 2026. So let's dive right into it. Here we've got a quick table of contents. I'm not going to run through all this. I'll provide a PDF with all the slides and the presentation in an email and blog that will be going out. So we won't dive into all of these. Now we're going to go through each of them individually. So market recap, these are just key headlines from the last quarter. So this slide is graphing the S&P 500 during the Q3, and it is overlaying some major economic and political events. So here's kind of the main takeaways here. So the S&P continued its steady rise over the last 3 months, building on the Q2 rally from April's low. It seems like a distant memory now, but April was a pretty tough period. Market dropped off substantially and rebounded really, really strong off of that. But the quarter was notably less volatile than Q2 as trade policy uncertainty eased and the economy stabilized. But it still included some multiple major events. The quarter started with the passage of the One Big Beautiful Bill Act. As we know, that's this huge tax legislation that basically extended the 2017 tax cuts. And after Congress passed the tax bill the first week of July, the market's focus shifted to the other outstanding themes, including Fed policy, the build out of the AI industry, which we'll talk more about, in trade policy. Debate around Fed policy and economy, it dominated the quarter, with inflation and labor market data being the main areas of focus. On the inflation front, multiple reports revealed price pressures on tariff-sensitive goods like furniture and apparel. But the broader impact was smaller than expected and relatively contained. So this helped to ease concerns around inflation risk. Meanwhile, labor market data softened, the unemployment rose as monthly job growth slowed. And while the Fed was previously worried about tariffs reigniting inflation, that concern now appeared misplaced a little bit as labor data softened. After a 9-month pause, the Fed made a decision to, of course, resume its rate cutting cycle in September, which we're now in. We're in October, but the rate cutting cycle is now in full swing. So the S&P did end the quarter near its all-time high, despite mixed signals from the economy. Mix of factors and themes supported the rally during the quarter. The Fed's decision to resume its rate cutting cycle provided interest rate relief to borrowers and reinforced expectations for a soft landing. So Q2 earnings did beat expectations after estimates were revised lower throughout the quarter due to tariffs and economic uncertainty. AI-related CapEx, so that's just basically capital expenditure, so spending on AI, continued to fuel strong earnings growth for mega cap tech stocks and drive overall growth. We'll discuss each of these major themes as we get further into it. So let's turn our attention to one particular theme, which is kind of cool, is small cap stocks. So one of the big themes during the quarter was the Fed rate cut and its impact on various corners of the market. So this slide graphs a quarterly price return gap between large and small cap stocks. So positive readings indicate small caps outperformed and negative readings indicate large caps outperformed. So the chart shows that small caps have consistently underperformed, as we all probably know, since basically 2021, with small outperforming in only 5 of the last 19 quarters. So quite a losing streak there. So 3 themes contributed to the performance gap. First, smaller companies' reliance on floating rate debt. It meant that they were impacted more by the Fed's rate hikes. And second, their smaller size left them with less pricing power relative to the larger companies, as inflation led to rising input costs. And third, small cap stocks have limited exposure to the leading AI companies. So these indices that contain these small capitalization stocks, they don't have a lot of exposure to AI. So So, which reported strong earnings growth. AI was really leading the way in terms of all of this growth, and small caps just don't have that much in terms of exposure there. So, together with these high rates, soaring inflation, and small caps AI underweight, created pretty significant performance lag, as we know. So, the performance trend started to reverse, however, in Q3, with small caps outperforming by 4%. Marks small caps' biggest quarter of outperformance over large caps since Q1 of 21, before the Fed started hiking rates and inflation soared to a 4-decade high and the AI industry emerged. So two themes contributed to small caps' outperformance in Q3. First, the Fed resumed its rate cutting cycle. The rate cuts are expected to provide interest rate relief to smaller companies, and the market is optimistic, obviously, that these lower rates will help cushion the U.S. economy from an economic slowdown. And second, small cap stocks benefited from a catch-up trade due to their steep valuation discount, compared to large caps. So the Russell 2000, the small cap index, hit a record high in late Q3 after the Fed's rate cuts, and that was its first new high since 21. So the market's watching to see if this outperformance carries, through the quarter and into the new year. We shall see. So there have been periods of small cap outperformance in recent years, but they've been really brief and infrequent. So the Fed's decision to resume rate cutting was the first step toward maybe narrowing that gap. Let's take a look at some other key themes, including this AI CapEx boom. So we're focusing here on the emerging AI industry, a key driver of large caps outperformance in recent years. So the chart on the left graphs investment in information processing equipment and software. So this is a subset of quarterly GDP. In Q2, tech investment grew 14% year over year. That's the fastest pace since 1990s. And that during that dot-com era, investment in computers and software grew 15% year over year. As telecom companies invested heavily in fiber and cell towers and all those things. So today's surge is driven by AI, no question. So it's with leading tech companies investing billions in computer chips to train AI models, these data centers, they have to run them, and new energy infrastructure to support it all. So the chart on the right shows how the current tech spending boom is impacting stock market returns. So it compares the price return of the Mag 7, which that includes mega cap AI leaders. You've heard these: NVIDIA, Microsoft, Amazon, all of those. And that's comparing it against the broader S&P 500. So over the past 2 years, the Mag 7's returned 150%, more than double the S&P 500, 60% return. So the catalyst here is AI companies' strong growth, which has been driven by the tech spending boom. So it's really difficult to overstate how much the AI CapEx, which is just a fancy term for it's just investments in long-term assets, is CapEx. So this cycle has impacted financial markets dramatically. So the AI industry build out has powered both equity markets and economic growth. So as tech spending grows at the fastest pace in decades, this AI CapEx cycle has become a major market theme. So, but it's also raised questions about what could happen if tech spending slows, which is inevitable at some point, and to a more normal rate, as we know. Everything is cyclical. But let's turn our attention now to corporate earnings. So this slide it's a two-part snapshot of corporate earnings performance for S&P companies. So the chart on the left graphs the percentage of S&P 500 companies beating earnings expectations each quarter. Over the past 5 years, an average of 78% of companies beat expectations each quarter. So this percentage of companies beating earnings was highest in 2020 and 2021 as the economy reopened from the pandemic and expectations remained relatively low. But the beat rate fell throughout 2022. This is likely due to tighter financial conditions, economic headwinds, and having to raise rates. But earnings performance did rebound in 23 and 24, with the beat rate rising back to average. So there was a slight dip in 24 and 25. This is an indication that expectations started to outpace actual results. But the beat rate rebounded in Q2 of this year after analysts lowered estimates earlier in the year. This was due to policy uncertainty, but corporate earnings have remained surprisingly resilient despite tariffs and all the rising policy uncertainty. So very resilient, very strong. So the chart on the right graphs earnings revision sentiment, which measures the net percentage of S&P companies with upward revisions. So revision sentiment spiked in recent months with a 1 month change of 24% and a 3-month average of 27%. So both readings rank in the top 10% of historical values. So this highlights a rare surge in Wall Street optimism. This level of positive sentiment hasn't been seen this very often, but when it has, 2010, 2018, 2021, it's followed periods of economic recovery or improving business conditions. So the two charts underscore the resilience of U.S. corporate earnings. And so, despite macroeconomic challenges, ranging from really aggressive rate hikes to trade policies to, companies have consistently managed to outperform. And so this trend reinforces, the strength and adaptability of corporate America. So, and as a result, analysts are raising earnings estimates, signaling confidence in both the economy and corporate profitability. So looking ahead, the question is whether companies can continue to beat what is now a very high bar. So it remains to be seen. Let's talk fixed income for a second. So always exciting. This slide shows corporate credit spreads are at levels not seen in decades. So the chart on the left graphs investment grade credit spreads. So this measures how much more a top rated company pays to borrow compared to the US government. So the current spread's about 0.75%. So it's, 75 basis points. A level last seen in 1998. It's a long time ago. So historically, the spread is closer to about 1.3%. Half percentage point higher, which is significant, obviously. The chart on the right shows high yield spreads are also tight, but not quite as extreme. Credit spreads stand out for how tight they are compared to history, with companies paying a smaller risk premium to borrow. So several factors probably explain why. First, yields remain high in absolute terms compared to the past decade, making corporate bonds attractive, even with tight spreads. But second, corporate fundamentals are healthy, strong earnings and growth, manageable debt, high interest rate coverage ratios, and in contrast, the market is concerned about the current trajectory of government finances. So in a reversal of roles, the government, not the companies, is paying a higher risk premium. So third, the Fed resumed its rate cutting cycle in September, and the market expects it to continue cutting rates into 26. So, investors are moving to lock in today's yields, basically. So while spreads are tight by historical standards, extreme valuations don't always correct quickly and often need a catalyst to normalize. So, what could shift the balance of risk and change the market's view? Two scenarios, maybe. So first, an economic slowdown or a decline in profit margins could cause the market to demand a higher risk premium, causing these spreads to widen. But second, if companies take advantage of their tight spreads and borrow more, it will increase the supply of corporate bonds. So an increase in supply, whether you're funding a merger, stock buybacks, or other things, it's without a corresponding rise in investor demand, it could cause spreads to widen and bond prices to fall. So these things always ebb and flow, but today's yields, they're somewhat compelling, but they come with important trade-offs here. Credit spreads are at multi-decade lows, and when spreads are this tight, there's less room for error, frankly. For investors, that means, we just have to understand the risks and, understand the quality and diversification within your bond exposure. So it's certainly not, this isn't signaling danger of any kind, but it's just not offering much of a margin of safety. That's all. Let's take a look at labor markets. So unemployment. So this slide examines labor market by charting U.S. monthly job growth since 2022. Labor market was exceptionally strong in 2022 with job growth surging as the economy reopened after the pandemic. But monthly job gains were strong throughout that year, reflecting robust demand and for workers. But by late 2022 and into 23, the pace of hiring began to slow as the initial reopening, that boost, it faded. So the Fed's rate hikes started to weigh on economic activity. But while the pace in 23 was still, healthy, it marked a clear slowdown from 2022. So the slowdown became more pronounced in 2024, but with monthly job growth becoming smaller and irregular. But there was a brief rebound in late 24 after the election as reduced policy uncertainty gave companies, the confidence to proceed with their investments and hiring plans. But the growth was not sustained, and in recent months, the labor market appears to be stalling out a little bit, with some months showing no real job growth. So the gradual slowdown from 20 to mid 24 indicates the labor market lost some momentum, possibly as higher interest rates and economic uncertainty weighed on hiring. Labor market often lags other economic data, so recent job losses may just reflect conditions that have been building for quarters. Regardless, the softer labor market has implications for workers and the economy, and for workers and businesses, it just signals a more cautious environment. Fewer job openings, more layoffs, potential for slower wage growth, things like that. But for policymakers, the slowdown suggests maybe monetary policy is too restrictive, and that it may be time to even lower rates even more. So, which is obviously what they're considering. Let's talk interest rates real quick. So obviously we are now, we've resumed rate cuts. So this is looking at an update on Federal Reserve policy. So it graphs the federal funds rate, which is, the interest rate the Fed raises and lowers to set policy. So to recap the last few years, Fed cut interest rates to near zero during the pandemic. It kept them near zero to March of 2022 when it began raising rates in response to surging inflation. So from then to July of 23, the central bank hiked rates by 5%. So this is one of the largest and fastest rate hiking cycles in history. So it held rates steady through September 2024 as it waited for inflation to return to the 2% target. The Fed started its rate cutting in September 2024, and it cut interest rates by a total of 1% over 3 meetings. But it paused the rate cutting cycle earlier this year due to concerns about the inflationary impact of tariffs. So after a 9-month pause, the central bank resumed its rate cutting cycle in September with a 25 basis point cut. That was expected. And so, policymakers cited signs of this labor market softness we've been talking about, pointing to slower job growth and rising unemployment. So, Jerome Powell framed this move as a risk management cut, describing it as a proactive step to take, to keep the economic expansion on track. So, rather than, possibly lead us into a recession. So looking ahead, the question is how much more will the Fed cut? So the Fed's latest forecast shows 2 more 25 basis point cuts this year and possibly another 2 in 26. So markets forecast is similar, with expectations of additional rate cuts in the coming months and quarters. Should be a boost to the economy. How much the Fed actually cuts will, that'll depend on a lot of things. We'll soon find out, I'm sure. Here's some further economic data, some mixed signals here. So this slide is taking a look at the U.S. economy and some of these mixed signals that are complicating the Fed's job. So it compares headline GDP growth against core GDP growth. And headline GDP captures the full picture of economic output, so including consumer spending, business investment, trade. But there's certain aspects of the economy are more volatile and can distort GDP, such as imports and exports and inventory stocking, government spending. But you can see this volatility in the navy line, which fluctuates more. Core GDP, which is the light blue bars, that excludes these volatile categories, and provides a clearer view of underlying consumer and business demand. So starting on the left, economic growth was strong in 21 as the economy reopened. Growth started to slow in 22 with both headline and core GDP falling. The timing of the slowdown coincided, with this 4-decade high inflation, a market sell-off, and the start of the Fed's aggressive rate hiking cycle, which likely weighed on the broader economic activity. But the chart shows that the economy rebounded sharply in 23 and 24 with headline and core GDP rising. So the data indicates that the economy started to adapt to the higher rates, which with robust spending and government spending. So that led to increased private investment. So this year's seen an increased economic volatility. So this headline GDP growth was negative in Q1. That was due to companies front-loading imports to beat tariffs and consumers slowing spending. But core GDP also weakened, with the combination indicating that economic activity did weaken as trade policy led to increased uncertainty. But GDP measures rebounded sharply in Q2, reverting to their 23 and 24 pace as trade policy eased and the stock market rallied to new highs. So, based on July and August data, the rebound appears to have carried forward into Q3. So there's a sharp divide. However, consumer spending is strong and AI CapEx is surging, but housing and non-AI business investment is struggling under these higher rates. So the Federal Reserve is trying to make sense of economic environment as it determines what to do next. So let's look at some key themes to, looking ahead over the next 6 months, let's call it. This slide is highlighting 3 market themes that we're watching over the next 6 months. So the first theme is the surge in AI-related capital expenditures, investment in long-term AI. Technology investment is growing at the fastest pace since the late 1990s, as we've said. It's fueled by this massive spending, of course, on AI. Many AI-related companies report growing backlogs that extend out multiple years, and management teams forecast continued spending growth. Expectations are high, and investors are treating the AI CapEx boom as a multi-year investment cycle. So the key question here is whether the current pace of tech investment can be sustained. The answer will have huge implications for the stock market and the broader economy, and as AI CapEx has powered the S&P, let's face it, to new highs and contributed to economic growth. So the second theme relates to the recent softening of the labor market. So as we discussed, job gains have slowed and unemployment rate rose to its highest level since 21. But there's a debate about whether the softness is a delayed result of the tariffs and policy uncertainty in Q2 or the start of a new labor market shift, tied to high interest rates and a cooling economy. So, this softness caused the Fed to cut rates, as we know, and the market will be watching labor data closely in this quarter. And so if the softness continues, it could justify additional rate cuts, or them speeding those up to support, the economy. Third theme relates to the Fed's recent rate cut. So after a 9-month pause, the Fed cut interest rates by 25 basis points in September, but the Fed and the market expect more rate cuts before year end and with more coming in 26. So the key question here is how lower interest rates will impact the real economy. Housing and manufacturing data have been weak since the Fed started hiking in 2022, but the market will be watching to see, whether these cuts spur a rebound in activity or not. So the economy's trajectory will be critical, I think, in determining the Fed's next steps and shaping market expectations. So here we're just taking a long-term perspective that, the good old power of compounding. So we've discussed, a range of important themes and slides and all these things impacting short-term movements. But with these slides, we're looking at resilient corporate earnings, tight credit spreads, soft labor market, economic signals, the rise of AI. It's been a busy year for the markets, and Q4 is shaping up to be no different, really. This slide kind of zooms out to look at the big picture here. So the chart tracks the growth of 10,000 invested in large cap stocks and bonds from 1975 to today. Dark blue line shows 10,000 invested in large cap stocks grew to $620,000, while the light blue line shows that same 10,000 invested in bonds grew steadily, but slowly to 200,000. So stocks, they can be volatile, as we know, in the short term, but they're historically deliver the highest long-term returns and the strongest protection against inflation. In contrast, bonds offer capital preservation and lower volatility, of course, but with more modest gains. So the gray shaded area represents inflation. To maintain the same purchasing power as $10,000 in 1975, an investment we need to have to grow to about 55,000 today. And so this highlights the importance of thinking in inflation adjusted terms. So saving money it's not enough. Investments, they have to grow faster than inflation to build real wealth. So, if savings were kept in cash, purchasing power would steadily decline. So beating inflation isn't just a nice to have, it's essential. While stocks can be riskier in the short term, as we know, and impacted by a long list of economic and macro themes, they've historically rewarded investors handsomely with decades of compounding growth. So, that said, it's important, of course, to consider risk tolerance, investment horizon, retirement planning, and the role of course, diversification within that, the building blocks of that portfolio. So that is all I have, guys. I really appreciate y'all's time today. We can just are so honored that you continue to trust us with you and your family's wealth. And of course, as always, please reach out to us with any questions. You can reach out to our team at any time, whether you're a client or not. We'd be happy to speak with you. Other than that, folks, have a great rest of your day, and we'll talk soon. Thanks.